Okay, today's topic is measuring value in real terms. A lot of people don't know what that means. They don't know that there are several ways to be able to look at value, and the worst way to look at value is using the US dollar because of consumer price indexing and the fake inflation rates that the government actually produces. We're getting ready because of dumb Biden's policies to move into a hyperinflationary period, which means cash will become pretty much worthless in 5 to 10 years. It's real. That is, if they can continue forward with these nonsense policies that are coming out of the libtard, woketard left. They don't know what they're doing. They have no idea how to be able to run an economy, and their policies, their green policies, are the policies of failure, much like everything else that comes out of the modern day Democrat policies, the modern day Democrat Party. These people don't know what they're doing, and anybody who votes for these people, you deserve what you get. All right, so we're going to use whiteboard again today, and I've already checked to make sure that this goes into frame. Hold it up so I can take a picture of it and stick it in there so everybody can see it. And then we'll go through it. All right. What you got to do, well, there's a couple ways to do it, but what I do is I go and find out what the spot silver rate is, price for silver is over what's called a 30-day moving average, right? So what you do is you find the spot rate today and you go back 30 days and you take the average, or what's called in statistics terms, it's called the mean. So you add them all up and you divide by 29 days, 30 days, 28 days, whatever it happens to be. All right? So then what you do is that gives you what's called the mean. So then what you do, you can do this in a spreadsheet very easily. What you do is you take the difference, there's the delta, right? Difference between the data point to the mean. So you go to, like, for example, the first day, and you subtract out. So let's say the spot. We'll keep it simple here. We're going to say the mean is 20, right? And then the data point is 19. It's gone down a whole dollar. Well, that data point would be $1. And you do that. You keep subtracting each individual day all the way back 30 days, right, from the mean, and then you add all. Then you take the average of those differences. Right? So you add up all those differences, and then you divide by 30, right? Well, 29, I guess. 29, right? And that gives you your variance. Right? And what the variance shows is the amount of spreadability and how much change there is within that period of time. All right? And then what you do is you take your variance, you square your variance, and that gives you your standard deviation. Right? And you should be somewhere around 1. All right, like 1.00695, whatever it is. If it were to be too much more than that, then you would have an awful lot of volatility in the marketplace, much like Bitcoin. If you were to do this for the daily rate on Bitcoin, it's all over the place. And the standard deviation is going to be very high, which means there's an awful lot of volatility in the market, which means you can't use it as a predictor of anything, all right? It's very difficult, right? And so your standard deviation is an example of how much spread there is that's going on between each individual data point within that, in this case, 30-day moving average. Okay, so you just go, you take the day and you go back 30 days, and tomorrow you take tomorrow's price and you go back 30 days. So it's 30-day moving average. All right. So you look, and so in 2022, being that this is in July, yesterday's, because I did the math on this yesterday. The 30-day moving average, right, is $20.61 in July of 2022. Okay, now this is all going somewhere, right? So then what you do is back in 1960, as an example, I use 1960. It's an easy date. The actual cost for a silver ounce round was $1.28, right? Now, back in the day, 1960, a silver dollar was made of silver, right? But it wasn't 100% silver. So if you wanted to buy silver bullion, you know, one ounce round of silver bullion, it would have cost you without, and we're eliminating interest here, we're eliminating any premiums, we're eliminating all that. We just try to keep it simple so that you get the idea of what you need to do to looking at value over time, all right, in real terms. So what you do is you look at it, oh, look at $1.28 in 1960, right? Today, the gold is at, well, and once again, this is a moving average, is $1,836. So that's $1,836 in 2022. The gold price back was set, and it's $35.27 for an ounce of gold in 1960. Now remember, minimum wage back in 1960 was $1 an hour. So it would take 35 and a quarter hours of labor without taxes and all this stuff. Keep it simple. 35 hours of labor to be able to buy 1 ounce of gold in 1960. Right? So that's almost a week's salary. Be almost a week's salary to be able to buy an ounce of gold. Right? So then, one of the things that you should look up online is what the Federal Reserve book value of gold is today, right? It's called the book value. So based on all the gold that the federal government has in the U.S. Treasury reserves, hypothetically anyway, and the Federal Reserve have on reserves, they book 1 ounce of gold is worth $42.20.2222, right? So that's interesting. Why don't they make the book value of gold somewhere near the floating price of gold? Well, there's a statutory reason why they don't do that. All right? So historically, using the 1960 values here, all right? 1960, the ratio of gold to silver was 27.5 ounces of silver to every 1 ounce of gold. Okay? Today, the ratio, it's 89 ounces of silver to 1 ounce of gold, which means that if you wanted to have parity with the same standard of living that an ounce of silver was worth back in the 1960s, right, silver would have to either go up to $66.76 an ounce, or gold would have to come down to $566.78 an ounce. All right, that kind of gives you an idea. Now you ask yourself, well, how is it that we're so out of coordination here? Well, that's inflation. That's inflation. Now there are some other things. Silver has a lot of intrinsic value in today's modern economy, much like it did in 1960, and gold has very little real intrinsic value. I mean, it's used in electronics, what are called fingers, for edge connectors and a few other things. But gold isn't used anywhere near as much as silver is. Silver is used in, for example, solar panels. It's used in electronics. It's used as a catalyst in all kinds of different processes. Silver has a lot of intrinsic value. Gold, on the other hand, is although it isn't, it's not used in industry as much. Gold in electronic boards, for example, are constantly recycled because of the value of the gold. Whereas the silver in electronics and a lot of other stuff actually just goes into the landfills and doesn't get recovered. So it has to be mined and constantly fabricated. All right, so I want to use a real-world example why this matters. Because everybody thinks that the prices of their houses are going up, when in fact, when you buy a house, in real terms, you sell your house 20 years later, 30 years later, you're actually losing money. Now, once again, I'm not including the cost of your mortgage. So if you buy a mortgage, obviously you're paying interest on that mortgage, and that would have to be, it's a summation. You would have to sum it over a period, it's called net present valuation. You have to sum it over a period of 20 or 30 years, whatever your mortgage is, and then you would have to look at the price of silver from month to month to month to month. You can do that on your own. I want to give you the principles so that you understand that you're actually losing money when you actually purchase a house. Everything you're making money. Oh, my house is worth $700,000 and I bought it at $200,000. Well, once again, the purchasing power of the dollar is going down. It's not that you're making money. You're actually losing money. You just don't understand how to be able to value, in this case, real property in real terms with respect to gold and silver. All right? Now, we'll take my mom's house, for example, back in the day. In 1960, $10,500. Okay, 3-bedroom, 1-bath house in Phoenix, Arizona, cinder block, the Alhambra district. All right, if you know Phoenix, Arizona, it's 35th Avenue in Bethany. Right, house was $10,500 at $1 an hour minimum wage. Right, that's $10,500, 10,500 hours worth of labor to be able to pay off that mortgage over a period of 20 years. It was a 20-year note. Right, now once again, you're paying interest on this and other fees, and so you, in essence, you double the price of the mortgage. So if you buy it for $10,500, you're looking at $21,000 cash out of pocket over a period of 20 years, including interest, to be able to service that debt. Okay, and anybody that's ever had a mortgage knows what I'm talking about. All right. So now let's turn this into real terms. Right. So at silver at $1.28 an ounce. Right. That works out to 13,440 hours of labor. Once again, we're not including interest. We're just keeping it simple. And in today's modern world, at $15 an hour, we're using, in this case, right down here, we're using labor in real terms, as opposed to just silver and gold. If you want to look at it, in how much labor today, out of pocket, at a $15 an hour minimum wage, my mom didn't buy that house for $10,500 or 10,500 hours worth of labor at $1 an hour. What did she do in modern terms? She bought it at $13,440, once again without interest, right? And in labor, it was right at about $200,000. All right, so that she didn't buy that house for $10,500. In a modern context, she bought that house at $200,000. Okay? Now, looking at silver at $1.28 an ounce, says it works out to 8,203 ounces of silver is the equivalent, right? That's the real term equivalent is 8,000. What you do? You take the price and you divide it into 10,005. That's 8,203 ounces of silver, right? Using today's price, that works out to $169,000 in actual silver, right? In today's equivalent. So she didn't buy that house for $10,500. She bought that house in today's equivalent using silver in the real sense at $169,000, right? But now let's look at gold, right? If you take $35.27 an ounce for gold and you divide it in, that gives you 298 ounces of gold. But at today's price for gold, which is $1,836 an ounce, she didn't buy that house for $200,000 or $196,000. In gold as real terms, she bought that house for $546,000 and change. $546,000 and change. Now you have to look at it this way. When she bought the house in if she had silver, let's say the seller, your buyer, someone else is the seller. If the seller were willing to take in trade bullion silver in exchange for that $10,500 price, right, it would have cost her $1,000. Where are we at? It would have cost 8,203 ounces of silver, and in today's value, that's $169,000. If the seller were willing to take gold, and my mom had gold, let's say she inherited a bunch of gold coins back, or bullion gold back in the day, that means that they would have been willing to accept just shy of 300 ounces of gold. But that would have been at $546,000. $546,000 in gold. All right? So what we're looking at is somewhere between $169,000 in real terms to $546,000. Now, my mom bought the house, which means she probably put in about $20,000 in actual cash over a period of 20 years, right? And she sold the house for $125,000. Well, the house, I should say, was sold for $125,000 after her death, which is what was 20. What's today? It was about 3 years ago. So 3 years ago. So it's 2019. 2019, right? So you would think, oh, she's made money on it. No, she hasn't. Obviously, she's lost money in any scheme. She lost money on that deal. All right, because you're losing what's called cost of capital. One of the other things that you have to do is what's called risk-adjusted discounting. where you look at the amount of money that you spent on the house that you could have used to be able to invest in something else. A zero risk, which would mean government bonds, for example, a zero risk interest rate. You have to discount the cost of capital on that. It's called K, the cost of capital. And you have to do risk-adjusted discounting to be able to tell how much money that you've actually lost, because not only did you lose the interest on this, but you lost the investment opportunity in a risk-free interest rate that you actually have to discount. And then that, well, of course, that even makes things worse, because that upside could have been used to buy Microsoft stock in 1986 or Apple stock in, 1974 or whenever they went public. So those opportunities are not there. This is just a sad truism. Who has more power? A person that's got $1 million in equity in their house and their house is paid off, or a person with $1 million in cash in their pocket? All right. Well, $1 million equity, what do you got to do? You got to go to the banks and borrow it, which means that your modified internal rate of return has to be higher, because you have to be able to pay that debt service. All right. So if you want to look this up, this is called modified internal rate of return. You want to be able to calculate in real terms your modified internal rate of return of your investment, and you separate out, you subtract out your cost of capital with a risk-adjusted discount rate. All right? So there we go. That's how you actually measure real value in real terms, real being silver or gold or ratios. You can use a ratio of silver to gold over time. Some people use energy. They look at the price of gasoline and natural gas and coal, and they take ratios from that, and they use energy as the ratio, right? You can look at the spot rates, contract rates for options and futures positions with respect to coal. You can use anything. Silver and gold are very easy, because everything boils down to energy. It takes energy to extract gold. It takes energy to extract silver, right? And the reason why you take out you do that 30-day, is because you want to smooth out that volatility. You want to be able to get a general idea, and that's why you go through this. You get a general idea of what it is that silver is trading at, or what gold is trading at. You can use spot rates if you want to, but if you're going to be looking long term, so that you can do the calculations on this, I use 30-day moving averages, and then of course you can use the LIBOR rate. There's lots of rates that you can use for risk-adjusted discounting on your risk-free interest rate. But anyway, there you go. Thanks for the time.